The first thing I would like to do is to give you a proper understanding of every product, every asset that could be traded in the local ICE Singapore exchange. Okay, the ICE Singapore exchange is really quite unique, and you will learn today why. Okay, and it's very, very convenient for traders. So many different products can be traded through ICE Singapore. Here's a useful website, www.theice.com/futures-singapore. And there you can get access to real-time information when it comes to everything available in the exchange in an updated fashion. So I'm showing you the website here. Okay, so you have, the products, digital assets, energy, FX, etc. Just a little added note on the bottom right, you have the Bitcoin market commentary, which Andrew, produces every week. Again, you could click, read it if you are into trading digital assets, Bitcoin specifically. And not only that, you can actually subscribe to it. It's free. And then every week you will receive an email with the market commentary. So certainly I recommend you to do that because it's a very rich market commentary with lots of useful stuff. Okay, so I would recommend you to do that. But again, coming back to our various assets that are tradable in the ICE Singapore exchange. One way to think about it is to think about all those products to belong into 4 groups. First group would be indices. Okay, and the key index here, and probably this is the index of the indexes. Okay, it's the mini US dollar index. Why? Because not only it's a very relevant index, since the US dollar is the currency that is employed in 80% of transactions worldwide. So obviously that is very relevant. But on top of that, almost everything that is tradable in the world is actually priced in US dollars. Maybe you trade oil, maybe you trade gold. In the end, those commodities, those other products, stocks, they often trade in US dollars. And therefore, understanding the US dollar not only is a great tool for us to trade, but on top of that, for us to do better trading anything else. So that's such a relevant index. Digital assets, backed Bitcoin. This is a fantastic contract to be traded. We'll talk more about that later on and the characteristics. But again, Bitcoin and digital assets, cryptocurrencies in general, certainly they are very relevant, more relevant every day. But the issue many times is that when you trade Bitcoin with some Bitcoin brokers, some Bitcoin wallet, some Bitcoin exchange, well, maybe you are using a good, stable, serious, regulated company, but also there are many cases out there where many problems have happened because of the decentralized, deregulated nature of cryptocurrencies in many places in the world. So one of the fantastic ways to be exposed to cryptocurrencies in a safe and regulated environment is to do it in the form of a futures contract. So instead of trading the Bitcoin, you trade futures contract of Bitcoin, and now you benefit from the cryptocurrencies and the beauty of them, but you do it in a safer environment. And this could be done very easily in the ICE Singapore exchange. And I have a few more advantages to share, which I'll do in a minute. Then we also have energy products like mini Brent, low sulfur gas oil, WTI crude. And finally, in the FX world, we got Singapore dollar, Chinese yuan, we got Hong Kong dollar, Indonesian rupiah, the Korean won, Malaysian ringgit, the Taiwanese dollar, Filipino peso, and also the Thai baht. So all of those are many, many products that, definitely locally in Asia are extremely useful, but beyond Asia, worldwide, those products are certainly very powerful. Now, what are some of the key characteristics that apply to these products specific to the ICE Singapore exchange? Well, first, there is no exchange data fees. Okay, other exchanges charge data fees. So for you to get charts on your screen, no matter the broker that you use, you may have to pay to get those charts. And that applies to many other exchanges, okay? But also other ICE exchanges, because ICE has exchanges in Europe, has exchanges in the US as well. So maybe you want to trade ICE US products, for example, and next thing you know, you have to pay data fees. But if you were to trade the Singapore version of the products in the local exchange in Singapore, next thing you know, now you don't have to pay exchange data fees, which is a great advantage. You need to keep in mind that ICE products are seen as very, very professional, and therefore many times the exchange fees are higher than other exchanges which may be seen as less professional. And this is a very generic statement, but I mean, you could do your own research and you would see it's quite accurate. So what's the beauty with ICE Singapore? Well, you get that professional product, but no data fees. Okay, so for exchange data for exchange data. Okay, so that's pretty cool. All contracts are cash settled, so you don't get physical delivery. Futures products were created for companies to get future delivery of products. I mean, this is going back to the beginning when futures products were created. That's a long time ago. Okay. We active traders, okay, if you were to be an active trader like I am, for example, really, we don't have any interest in acquiring physical delivery of Brent crude oil. We don't want that. We just want to make a profit out of the price movement, okay? But what if you have made a mistake and you left a contract open for too long because you didn't realize that, today was first notice day or something like that? Well, next thing you know, you may be in a situation where you get delivered. And again, your brokers are supposed to protect you against that, and they may roll over the contracts for you automatically. But what if something happened and there was a mistake made in the systems? Next thing you know, now you could get physical delivery, and that could be a very big problem. Well, what's the good thing with ICE Singapore products? Well, the very powerful characteristic, another very powerful characteristic, is that all contracts being cash settled, you will never get physical delivery. You will get whatever P&L it is, either a profit or a loss, that will be cash settled in your account, but you will never get to, have to have to go through a delivery process, which implies losing the leverage. Now you have a storage problem. I mean, again, that would be great to get delivery of oil if you are, let's say, Singapore Airlines. But as individual traders or fund managers, again, it's not ideal, isn't it? So very convenient characteristics as well. And finally, talking about convenience, all contracts are mini. And mini contracts means that they are smaller size compared to what you find in other exchanges. And the reason why this is beautiful is because it allows you to be more flexible on how you enter and exit trades. So let's say you want to enter a trade, and given your account size, you should be exposed to, let's say, 10,000 Singapore dollars. Okay? Well, the beauty of using mini contracts is that now you could take that one trade with that one contract. But let's say your account size now allowed you to take a trade with $100,000. So what you could do is, instead of one contract, you could actually get 10, which is the same size. But now what you could do is, maybe have an intermediate target where you close 5 contracts for a partial profit and leave the other 5 contracts running to ideally maximize your final profit, okay? Or same thing in the entrance, okay? When you initiate a trade where you may want to scale in to get in, you can also scale out to get out, okay? Again, that's a pretty convenient feature for you out there watching this training. Coming from the world of Forex trading, you may be very used to trade standard lots, mini lots, and micro lots. Well, the mini contracts in futures, let's say they are equivalent to what would be understood or seen as micro lots in Forex, and therefore gives you a great flexibility on position sizing, okay? So let's talk about the mechanics on how those markets work. Well, if we go back to our 4 groups, the indices, digital assets, energy, and Forex, the first thing to be able to trade futures products, okay, and for you out there, futures traders, you know that, is that you need to find out your symbol roots, okay? You need to find out your symbol roots, then you need to find out the expiration date and the year, and the symbol root plus the expiration date plus the year. The 3 together constitute the ticker symbol that you need to type in your trading platform for you to trade. Okay, so what's the ticker symbol? What's the root for the dollar index? It's SDX. What's the root for the back Bitcoin? BMC. What about the brand? BM, gas oil, GM, WTI, TM. And then for the currencies, we got SGD, CHM, HHD, SID, SWD, SMD, SND, SPD, SBD. Okay, well, again, it's on the screen. I guess it's self-explanatory, but it's important for you to have a proper understanding. And when you trade, make sure you type the right symbol so you execute the trade using the right contract. Could be a terrible mistake to type, SDX when you mean to type BMC. Now, I said that in order for you to type the right ticker symbol for you to trade, you need to know the symbol root, and then you take the symbol root and you need to add the expiration date. Where the ICE Singapore Exchange, to be honest, is very simple to trade because there is one exception, and apart from that one exception, all contracts, no matter the product, they have expiration dates every month. So you have the January expiration, the February expiration, the March expiration, April expiration, all the way to December for all contracts. And the only one exception is with the dollar index, the mini dollar index, which expires on the classical 4 expiration dates that many futures products expire, which is March and June and September and December, which are normally called or known as HMUZ. Okay, those are the 4 expiration dates. Okay, and by the way, if you are not aware of this or you didn't know that, so again, it's kind of like you want to memorize HMUZ. Okay, and if you memorize that, that's it. Now you know the expiration dates to be traded. Okay, so is it are we March? Okay, yeah. So if you want to trade March, you would trade the H. Okay, if you, let's say we are now trading the June, so you would trade the M. So the symbol that you would trade basically would be SDX, and then you would add the H or the M. Let's say it's the M, and then the year 21. Again, some brokers may have you add 2021. Different brokers may have slight variations with the ticker symbols, but basically, it would be the root and the expiration month and the year. And this is how it works in futures. Nothing new to you if you're trading futures. But again, hopefully this table clarifies and brings lots of simplicity for you to understand the ICE Singapore products, where everything has expiration dates every month. The only exception is the dollar index with every 3 months. The ticks and the values, okay? And here, of course, we do have more diversity, okay? Why? Well, that's obvious, okay? Because now we are talking about the very specific nature of the markets, the very specific pricing of those markets, the very specific volatility attached to some markets. Some markets are very volatile. Some markets are not volatile at all. Like the Bitcoin, it's, the price of Bitcoin in US dollars, it's multiple digits, right? Where if you are looking at the currency exchange between, let's say, Singapore dollar and a US dollar, it's much, much less, correct? Each market got its own nature. And in this sense, a market like Bitcoin, which is, thousands of dollars to get one Bitcoin, versus an exchange between two currencies, which may be, kind of like a decimal ratio, like, 1.25. So obviously we are talking about decimal places versus non-decimal places, volatile versus non-volatile. So here, this is part of futures trading. And unfortunately, this cannot be simplified. It's what it is. And it may even change through time, even though it's rare. But then the exchange would notify you, typically with an email, and your brokers too, okay? So with the dollar index, the minimum price fluctuation is 0.005. And the dollar index varies by that amount. You either make or lose $1 as long as you are trading one contract. Okay, of course, if you trade 2 contracts, it's double. If you trade 10 contracts, it's 10 times more. So the values here are per contract. Let's say you trade Bitcoin and the value of the Bitcoin goes up by 2.5. Well, you make 2.5, or you lose 2.5 if it goes against you and you trade one contract. Okay. What about the Brent? 001 is $1. What about the currencies? Well, it's important to notice that with a Sing dollar, for every 0.0005, you make 50 cents, or you lose 50 cents per contract, but that's 50 cents using Sing dollars as unit for the measurement. With the Chinese yuan, okay, every 0001, it's 1 yuan that you make or you lose, depending if the currency moves your way or against you per contract. And notice is measured in yuan, okay, which is a Chinese currency. Everything else is US dollars, okay? So again, this is a handy table to print, to have next to you, close by, or something like that, until you get used to it after trading for a while, and you kind of know the markets that you trade by heart. Probably when you trade futures products, you know, even if you're active, you don't end up trading all the products available in an exchange. Maybe you pick 2, maybe you pick 4, maybe you pick 6 products. I don't know, that depends on how active you want to be. But in the end, you know, let's say you trade 3 products. So again, you would just need to remember 3 values. And that after a few trades, you know, that will be embedded in how you think about trading for the rest of your life, isn't it? So it's not that complicated in the end, and hopefully this table is useful. What about trading times? Well, Singapore products, you know, close 2 hours a day, and this applies to all products. All products begin trading at 8 a.m. local time in Singapore, and start trading at 8 a.m., keep trading the whole day, keep trading the whole night, all the way to next day in the morning at 6 a.m., where the market will close and reopens again at 8 a.m. So in other words, no matter the product, we have 2 hours of closing every day, okay? So how are we gonna trade those products? Well, first, we're gonna load a chart with a futures contract you plan to trade, and apply your trading methodology and place an order with your trade parameters. That's one way on how to do it, which is definitely valid. And this is basically me saying that you could trade Singapore products like you would trade anything else. Okay, you load the chart with the ticker symbol of your choice. Maybe you trade the dollar index, so you load the dollar index and you go for it. That's it. Having said that, this is not the only way on how to do it. And if I was to share my preference, actually the second item would be more of, you know, what I would think of a more complete way on how to do it, because you would get access to more complete data in order to plan your trades. So what do I mean by more complete? Let me show it to you and let's explain it further. Second way on how to approach it would be to load a chart with the underlying product, the futures contract you plan to trade, derive its value from. So for example, if you want to trade the dollar index futures, instead of charting the dollar index future, a very smart approach would be to chart the dollar index itself. The dollar index is not a tradable asset, but is chartable, okay? Just like you could chart the Singapore dollar Forex currency pair, which is the interbank exchange for Singapore dollar, and then turn around and trade the futures contract that derive its value from the Singapore dollar currency. So you could chart the underlying asset, plan the trade on the underlying asset, and then execute using the futures contract. And this is kind of a little bit of a more complete way on how to think about planning your trade. I'm using the word complete because, for example, we learn that the futures market closes 2 hours a day. Well, the Forex markets don't close. So for example, if you are charting the Singapore dollar currency pair, next thing you know, you would have a 24-hour visibility of all the key price points for your trades. And then you can go ahead and execute the trade using futures contracts. So you benefit from the regulated environment, you benefit from the mini contracts, you benefit from, you know, the beauty of trading in an exchange. But again, at the same time, when you are planning the trade, your understanding of the product you trade is not based on the futures contract, but based on the underlying product itself. So that's why I'm using the term complete. Okay. Again, I, as a trader, as a person, I am a bit in the perfectionist side. You could keep it simple or simpler. You could make it more complete if that's your choice. I'm just sharing two ways depending on your approach and trading personality. And certainly you could go ahead and take a look and see what works best for you. But certainly I would see the second choice as a more, again, complete choice. So you would go ahead and chart the underlying product. You would apply your trading methodology to that underlying product. And then you would place a conditional order with your trade parameters using the ticker symbol that corresponds with the futures contract you want to trade. In other words, and we're going to show that on the charts, by the way. Okay, this is a lot of time spent on a slide with written words, so we're going to see that on the chart in a few minutes. But I want to explain it one more time. So let's say you are trading the dollar index, and you want to do that using DXY, which is the dollar index itself, which is not tradable. Okay, so what would you do? You would chart DXY, and then when it's time to place an order, okay, what would you do? Well, you would want to place an order with SDX, which SDX is the mini dollar index futures contract. Okay, so this is the tradable asset. DXY is not tradable, but is chartable. So we just chart and plan the trade using DXY, execute using SDX, but based on the prices of DXY. That's what we mean by a conditional order. So your platform will need to allow for such type of trades, which, by the way, not all platforms allow to do that, or maybe it's a bit too cumbersome for you and you prefer to do it differently. So I'm going to show you an alternative way on how to do it, which we call to calculate a price equivalence. I'm getting there in a minute, okay? But again, if you were to use conditional orders, you would plan the trades utilizing DXY, place the order using SDX, but basically your orders will state buy SDX if DXY hits that price level, and then sell SDX if DXY hits that other price level. Okay, so that's a conditional order. And again, I also want to give you a method on how to do a price equivalence calculation. Very good. So again, option number one, chart the future contract, apply the methodology to the futures contract, and take the trade. Option number two, chart the underlying and trade the futures contract. Okay? And within option number two, we also have two options, which is use conditional orders or calculate the price equivalence. To calculate equivalencies, step one, you would identify a clear beginning and end of an impulsive move in a larger time frame, such as a daily time frame. You would draw these Fibonacci lines from 0 to 100%, and then you would do the same using the futures contract. Okay? So in other words, let's say you look at DXY. Okay? And DXY is doing something like that. So that would be the beginning and the end of an impulsive move. So that would be your 0%, and that would be your 100%, or vice versa, depending on how you draw your fibs. Okay? So you would identify that on DXY, and then you would go find SDX, okay? Assuming that you're doing the dollar index. You could do the same with Bitcoin and BMC, or you could do the same with, SGD, with Singapore dollar, and then the Singapore dollar futures, SGD as well. So you name it. So then you would do exactly the same thing with the SDX chart. Okay, and of course you would get that value in the bottom part and that value on the top part would be slightly different when comparing DXY and SDX, because futures contracts either got something called contango or backwardation built in. So the prices would be slightly different. So what would you do? You would input that 0% and 100% values in a spreadsheet that we're going to share later in the presentation. And thanks to that spreadsheet, you will now get those equivalent values, and you will be able to use those values to place your orders in your trading platform, no matter the broker, even if your broker doesn't have the feature of using conditional orders. Okay. So we think about trading like you need to answer two questions. Question one, listen carefully, this is critical. Question one would be, is it time to trade, yes or no? That's question one. Because if it's not time to trade, why do you even trade? You know, the market may be too slow for you to trade. The market may be too volatile, too crazy. The market may have moved too much already, too far, too fast, and it's too late. You are late to the party. Again, if you don't have a statistical advantage, why would you trade? So step one is all about finding out if it's time to trade or not. And of course, if it's time to trade, which side of the market should you be in? Should you be a buyer or should you be a seller? All of this falls within question one. Is it time to trade, yes or no? And if so, should you be a buyer or should you be a seller? Okay, so in this case, I'm gonna pretend that I am a trader using the 1 hour time frame because I want to be active intraday, and I'm looking at the 1 hour time frame. Let's say this is part of my trade plan, and therefore this is what I'm gonna demonstrate in this first example. So how would I know if it's time to trade or not, and if it's time to be a buyer or to be a seller? Well, in our case, what we do is that we use a tool called AutoClimate, okay, which by the way is free for everyone. So if you want to get access to AutoClimate, you can also email us, and we'll be delighted to grant you access to AutoClimate if you don't have it yet. But basically, AutoClimate tells you if it's sunny or rainy, okay, if it's time to go or time not to go, stay home or time to go out. And the way, let me zoom in. So the way basically AutoClimate works is that sometimes you have these thin dots, sometimes you have these thick dots, okay? And basically thin, okay, tells you unconfirmed, so no time to trade, where thick tells you confirmed, which means you have a statistical advantage and it is indeed time to trade now, okay? So now that it's time to trade, I guess you are guessing it, the color is what you want to see. Red tells you it's time to be a seller, blue tells you it's time to be a buyer. Now, of course, I am pointing at dots on the left just so I show you diversity when it comes to the dots. I show you thin and thick dots, and I showed you red and blue dots. But what matters is not what you got on the left. What matters is the last dot on the right that tells you the present. So the present right now on the 1 hour time frame for the dollar index, to be honest, is to not to trade. The dot is thin, the climate is not confirmed, so time to sit on your hands and check again 1 hour later, because every 1 hour you will get updates if you trade the 1 hour time frame. If you trade another time frame, then of course you will get a different reading. So let's say I was trading the daily time frame, so now it would be time to trade the dollar index, and you would want to be a buyer because the dot is thick and the color is blue. Okay, so in any case, I'm just gonna go back to 1 hour, which is what I was doing. So I continue with my example. Okay, so right now, no time to trade on the dollar index. But what I could do though is I could use market replay. Okay, and with market replay, I could demonstrate what could you have done earlier in the day trading the mini US dollar index. Okay, so notice how here, okay, and this, by the way I have set up my charts is US time in this case, so it doesn't matter if it's US time or not, but that was just a few hours ago, like 4 or 5 hours ago. We got a dot going from thin red to thick blue. Okay, so let's pretend, which coincides with the market opening. Okay, that was the market open, and next thing you know, second candle gave us a thick blue dot. Okay, so let's pretend, okay, I'm going to use market replay on the right where I got my 5-minute time frame. Okay, and I'm going to pretend it is 7:30 more or less here. Okay, Here we go. So what would you do? Okay. So chart on the left is telling you right there when it was 7:30 in the morning. The chart on the left is telling you time to be a buyer, time to trade. That's question one. So what would you do on the chart on the right, which is a lower time frame, 5 minutes in this case, in this example? What would you do? Well, you would now want to answer question number two, which I haven't explained yet, which basically question number two is that now that I know I want to be a buyer, which is answer number one. So question number two is, okay, so which price do I buy at and which price do I sell at? So what are my entries and my exits? Okay, and just like in order for me to define the answer to question one, I use AutoClimate. To define the answer to question number two, I use another app called AutoUFOs, which UFO stands for on-field orders. And when I click on hide, so the UFO show up. So notice what just happened. We just had a UFO show up here at this moment in time that tells us that anywhere between 9206 or something like that and 9204, they are buy on field orders in the context of an up climate at that time earlier in the day for 5 hours earlier. Okay, so what would you want to do? Well, one smart action to be taken, okay, and I'm not saying it's a guaranteed profit, we'll see what's going to happen, but one smart action to be taken will be to buy at this price point with a stop below. So if you're wrong, you're going to lose that amount, the vertical distance. And then notice we got a red UFO above. So green UFO means buy orders, red UFO means sell orders. So what would you do? You will want to set that price point as your target. So in other words, you would be ready to make that amount of money, that vertical distance of profits, and you would be ready to lose that amount of money, which is that smaller vertical distance. So you have a risk versus reward, which is positive. It's probably 2 to 1, 2.5 to 1, something like that. And let's pretend that matches your rules. So you would want to go ahead and take the trade. So what would happen if that's the case? Okay, so price just came where the UFO was. So you would now place an order to buy SDX, okay, because this is DXY. You would not trade DXY. DXY is not tradable, it's an index. But SDX is tradable. So you would just use your trading platform to place an order on SDX. And then that market bounced a little bit. So now you are a little bit in profit. Keep bouncing a little bit more. Keep bouncing a little bit more. So now maybe you go ahead and you start trailing stop, and your stop that was located in that location now is moved to break even. So if this market was to come and stop you out, you would not make money, you would not lose money, assuming that you have a break even methodology. Maybe not, maybe yes. So keep going, keep going. Oh, a new UFO just showed up. Okay, so more on-field orders just appear in the market. So you may want to move your stop below here, or if you missed this trade because you were not available at that time during the day, so guess what? You could plan on a brand new trade by having a buying price here with a stopping price there with a target price here, okay? And if that was to be the case, okay, so you would just, okay, so notice that price came to where the UFO was, okay? And if you took this trade, it went below the UFO, so the second trade you would be stopped out. Okay, so on the second trade you would have lost money. On the first trade you would have made a little bit of money. Okay, and price went all the way down. So again, this first trade of the day, and at the very beginning of this new climate, was not the best trade ever. But if you took trade number one, you made a little bit of profit, and if you took trade number two, you took just one small loss. Okay, later in the day, okay, you just wait, because the climate is still blue. So you just wait for green UFOs to show up. Here we go. Now you have another green UFO that showed up. So what would you do? Do it again. So when price comes to the UFO, you buy. When price goes below the UFO, you sell. That's your stop loss. When price goes to the rival red UFO, that would be your target. This will be a small profit, to be honest. It's kind of like a one-to-one. But again, depending on your trading plan, you may take it or not. So price came to the UFO. So when price came to the UFO area, you would buy SDX, that would be trade number 3 if you did that. And now as price is moving up, so this was a full profit, it got to the red UFO, so you will close the trade for a profit and now ready to do it again, okay? But my point was to propose that in order to trade those products, you can approach it in 2 ways, which is to trade the product by planning the trade on the product, or to trade the product by planning the trade on the underlying asset, which is what I have just done here, using DXY in order to trade SDX.
Maybe let's just take a look at things from a, maybe a slightly, intraday perspective, where maybe, you are currently working, or, you have part-time work and you're able to spend a little bit of time preparing for your trades, say in the morning or the day before, on the weekend. And what you would tend to do is, probably start with the daily chart, and this is where you would, take the highs and the lows based on the dollar index, right, and plug that into your worksheet, okay? And so what we're trying to do here is identify, first of all, a little and prepare a little bit of this worksheet so that we're ready for doing the next step of analysis. So the high I've actually already got plugged in here was 92.53, and the low down the bottom here was 89.68. So let's round it up to 2 decimals, right? And so what that will give us is the distance, okay, between the high and that swing low. Okay. So that's what we've got here, and you can use the Fibonacci tool, right, in order to get those 2 points, as well as the Fibonacci levels here, right? And what we're trying to do here is, again, determine the baseline, right, for which we can now measure against the SDX, the futures contract, right? Also taking the high and the low, right? And also those Fibonacci levels. And again, we would plug those in, right, to our spreadsheet, 92.43 and 89.75, right down below here. And these numbers, right, Fibonacci numbers, will calculate out, right? So you can see here that is, and then what it will do is it'll give you this ratio, right? And so again, what we're trying to do here is identify the equivalent levels within the futures contract, right, with the underlying dollar index, right? So those ratios, right, will give us this factor, right? And what that will do then is, when we plug in these UFO levels, right, where we are looking to either sell at, right, or buy at, it will give us the approximate equivalent level on the futures contract itself. Okay, so once we've done that, right, now we just go back to our UFOs. So if we looked at the climate earlier on the daily time frame, right, we would see that the auto climate would be, in this case, right, because it's the larger time frame that we're trying to understand the climate of the market, right, is a blue, a confirmed market climate, giving a bias towards the upside, right? So we have more of an upward move, and overall this is the sense that we get, right, from the price action that we're seeing here on the dollar index. So whether you use a moving average to help you see to define the trends, or let's say that you use some sort of trend line, right, where you go from this pivot low to this pivot high, right, that will also give you further confirmation, right, if you use trend lines, that we've got a market that has a bias to the upside, right? And one of the other things you would probably note as well is we have this prior high here, right? And so when you're doing your strategic planning, more than likely you would come to some sort of conclusion that would say that overall prices is currently indicating that it's going to move up higher, and maybe the target for where you want to take some profits could be at this UFO here on the daily time frame. So you would use the UFOs on these high time frames to help you identify some of the target areas, right? So now that we have the context of the trade, let's go down to the 1 hour time frame. And here what we're able to do at this point is identify that there are buy UFOs down below at 90, at 91. And what we're going to do is mark out these areas on our chart for where we're interested in buying. And what I'm going to do is I'm going to use this whole area here where we have a stack of unfilled orders. Just going to draw an array here at the top and an array down the bottom so that we have price points show up. And I'm going to do the same on the short side, right? If we're expecting that price is going to move to the upside, then really what we would want to do is plan, right, for an entry down at this 91 and 90.97 area, okay? And what we would want to do is take that number, go to Excel spreadsheet, and enter that number here in the equivalence table, right? Which is essentially gives us 20 pips, right? And what that does is it gives us the equivalent entry point for the Singapore dollar index. So the US dollar index, right? Traded through iSingapore at 91.03 and 90.83. Okay. In terms of our target, 92.24, 92.7. And what that will do is give us our target of 92 point, let's call it 15. So let's say you're using Phillips Futures as your broker, right, to trade through. What you would do is go to the trading platform, which could be CQG, it could be Phillips Nova, could be one of the other technologies that they have available to their clients, and you would go to that platform and place your order, okay, with those parameters of an entry of 91.03, okay, and then the stop 90.83. 90.83, and then our target, okay, is going to be 92.15. So your risk is going to be the difference, right, between 91.03 and 90.83, so that's 20 pips. And your reward is going to be the difference between the entry point and your target. Okay, so that's going to be 112 pips. Now you may get out a little earlier there, just so that before all of the sellers come in, you get your profits. Okay, so let's take off a couple of pips there, just so that we get out a little bit earlier. And so what you would have here is a risk and reward ratio, 5.5 risk reward ratio. Now you may have other techniques that you use to take profits, right? And that will be the cool thing about the mini dollar index contract, which is, if you wanted to have 2 contracts, right, and take one off at say 1-to-1 or 2-to-1, then you're able to do that. Or if you, and then let the other contract ride all the way to your final target, right? Could be one way that you manage your trades, right? So again, we have the say the daily charts on both of these markets, right? And we identify the highs and the lows, right? The highs and the lows. And let's say that you want to look at more of the more recent swing. So we take the highs and the lows, and using the Fibonacci tool, okay, and we see what those values are. Okay, and we enter those numbers into our equivalency table. So for the underlying, right, we have 61,798.4, and we have the low point at 43,044. And on the underlying contract, well, I shouldn't say the underlying contract, the contract itself is, so it's 6785, and that low point is 45,358. And that will calculate our ratios there, right? So that when we enter in our sell UFOs and our buy UFO points, right, we're able to get the equivalent of this underlying market aligned with the contract itself. Okay, so now this is where we go to Bitcoin. It's getting ready for something, right? Now, if it's going to be a break to the upside, we don't know. If it's going to be a break to the downside, we don't know. But what we do know is that the autoclimate is telling us we are in a bullish climate, right? So therefore, you would have more of a bias, again, to the buy side. Okay? So for our shorter term time frame, on the hourly, right, we would be focusing on these green UFOs, right, and looking for these buying opportunities. Okay. And so here we have the UFOs identifying something quite close and nearby. Okay, down to this level here. Okay, so that's going to be, I'm going to move this, put a new one. Right here at 56,748. And if we have our stop, given that we have another green UFO here, as well as down here, we're going to go to this low point here. Okay, put our stop down there. Put our entry up here. And as we can see here, we've got a red UFO up here. So that's where we expect sellers to come into the market. And so we're going to put our target up here. Okay, put that up here. And so that's going to be 59,028. All right, so once we have that information, we're going to go to our table here. So our target is 59,028. Put that over here first. And our entry was at 56.48, 7.48. And our stop we were going to put down at 55,650. And then what that will do is give us our equivalents on the BMC contract. So here the equivalent entry and exit points is 57,400.3 and 56,289.7, and your target, and we said was going to be 59,706.5, and your risk reward set is about 2.1. Now, of course, right, if these parameters are within your trading plan or within what you expect, right? If you are looking for a risk and reward opportunity that is greater than 2:1, then you'd kind of pass on this opportunity, right? Or if the risk is too high, right, then you would probably need to look at opportunities which are a little less at the 1 hour time frame. You may have to go down to a lower time frame in order to ensure that your risk and reward parameters are in accordance to your expectations, not only from the risk and reward ratio perspective, but also from the actual risk value. So we know that the US dollar has been pretty strong, right? And so this is a chart of the US dollar versus Singapore dollar. And so more of late, right, the US dollar has been showing you some strength, but overall, right, since May of last year, we've seen the dollar weaken dramatically, and we've come down to almost the prior lows down below here. Okay, so if you've got a dollar-based brokerage account, right, and you've been holding, if you converted at this point, right, now your account expressed in Singapore dollars is a lot less, right? And so each time you're trying to bring profits back, you're going to be essentially, bringing, less Singapore, converting your US dollars into less Singapore dollar equivalent, right? And so it means that you're losing out essentially, right? So when we talk about hedging, right, we really want to be, if we don't have access to the forward markets, right, as a lot of big corporates do, then we may want to use the Singapore dollar futures contract to help hedge your US dollar risk, right, or your US dollar exposure. And so, by understanding how to read the chart, you understand, well, hey, since the dollar is such at a low point, there's really nothing much to really hedge at this point, unless the US dollar strengthens and you expect the dollar to continue lower. So currently, you would probably say to yourself, okay, until price probably comes back up to these areas, like back up to say 1.4. At that point, you may want to consider hedging by selling a US dollar if your view of the dollar was that it's going to pull back up to this level and head lower again. So to initiate a hedge at that point could be a valid scenario, right? But at this point, if you're looking for dollar to strengthen, and let's say that you wanted to, you didn't hedge, up here and all the way down, you were to maybe, recover some of those, losses that you had incurred, but you could still go long, right? The US dollar and sell the Singapore dollar as it moves to the upside. But by forming a view, right, of the currency and its direction relative to the US dollar, you're able to at least take some action, right, to mitigate any losses that you may incur due to the conversion of US dollar back into Singapore dollars. Or let's say you're looking to fund your account, right? And so you want to convert Singapore dollars into US dollars. Again, you could potentially, let's say, plan. Let's say you plan to do that, in another month or so, right? You could use one of the other forward contracts, right, of the Singapore dollar, in order to do that. So that's the beauty of these mini dollar contracts as well, is that they have monthly expirations. So you could actually plan, right, for the future, right, conversions of your to fund your account by looking at those contracts as well. Okay, so that's just a little little bit of conversation on how these contracts could also be used if you're not looking to trade specifically the Singapore dollar contract, mini contract. But that's how you could actually use it to actually protect your account if you are more of a trader in, let's say, dollar itself, or in the Chinese yuan, or Bitcoin.